Good morning, everyone. We'll just give a few minutes for all our participants today to, or a few moments rather, for all our participants today to jump on. As you're doing that, welcome to today. I've got the pleasure of hosting Nilay Shah, who is our SMSF Manager and resident expert on self-managed superannuation. And Nilay will be talking with me today about the top 5 ways to reduce tax with superannuation. And many of you joining us today are Wilson Pateras clients who have self-managed superannuation funds and have no doubt utilised some of the benefits. But what we thought we'd do for you today was to summarise the top 5 takeaways of where we think superannuation sits in terms of giving you the maximum tax benefit. So it's about a half an hour presentation. We'll try and stick to that half an hour. And we invite you to ask your questions. So you notice there in the chat and the Q&A box, there's the ability for you to ask your questions. So please do. We'll answer those throughout the course of today's presentation. So moving along, the first thing I just wanted to discuss with everybody was superannuation in the first place. Why superannuation? And it can be a bit of a complex question, and we have these conversations quite often with our clients around why we use superannuation and what we do. And I wanted to give just some clarity and context as to where it sits overall in people's affairs. So that little chart I have there for you talks about just saying, what's the tax savings in super? What does it mean from a wealth perspective? Because ultimately that's what we're talking about. We're talking about how do we maximize people's wealth through tax savings. So there's generally 2 strategies for people to grow their wealth. One is to grow wealth outside of superannuation. That's you growing wealth by earning an income through a work or a business, taking that income, and often there's leverage or borrowing involved. So that's a sort of a leverage strategy outside of super. The second option with super is to generally grow your wealth in a super fund without borrowing. So the benefit of outside super is borrowing. Inside super, the benefit's tax rates. That's the benefit. So you can see there, if someone was to have a strategy to grow their wealth, they would probably have a lot more money if they use super where they're not borrowing. And that's because of the low tax rates and the compounding benefits. So our presentation today is very relevant because it means you can get some more information about how to maximize those tax benefits to essentially end up with more money in your superannuation. As part of marketing today's presentation, I did do a little note to all of our clients around why you want to do superannuation at certain times. And I broke things up into the in ages, in fact. So when you're under 40, between 40 and roughly 60, and then 60 and beyond. So I think for people under 40, superannuation is pretty hard. But for people who are between 40 and 60, it's a real golden opportunity to build up over a period of time through consistent contributions a healthy super fund, which is then utilised ultimately as a retirement asset. So without further ado, I'll go across to Nilay and look forward to hearing more from Nilay.
Thanks, Nick. Good morning, everyone. The very first tip we'll be talking about today is the member contributions. Generally, there are 2 types of contributions, but we talk about the concessional contributions where you can have deductions. So this one is the catch-up concessional contributions where you can make more than $25,000 worth of contribution in super fund, which means on the other entity, you can claim that more than $25,000 as a deductions. What is the eligibility for that? Let's have a look of it. If your super fund balance is less than 500,000 as of 30th of June, 2020, and the other thing is you haven't utilized your previous year's concessional contributions up to the max limit, which is 25,000. So what we are looking here is current year's cap plus unused cap of the previous year. Let's have an example of that. John and Susie have a super fund. They haven't made any concessional contributions in 2020 financial year. And that's why in 2021 financial year, they both can make $50,000 worth of concessional contributions. instead of 50,000 previously they could do. But now see the benefit of the tax from that point of view. For example, if the business income was 300,000, without claiming the deductions, they could end up paying, for example, 30% to keep the calculation simple, 30% tax rate at the businesses. So they end up paying $90,000 worth of tax. Compared to this situation, $100,000 worth of concessional contributions. So the business net income is 200,000, and the business pays tax 60,000. The super fund pays tax 15,000. So the next tax savings is 15,000 because 90,000 minus 75,000 in total tax paid. That's a significant amount of tax savings from that point of view.
So Nilay, we have a quick question from Steve. And Steve's question is that the previous year or previous years? So is that limited to not making your contributions in 2020 or does it include 19 as well as an example?
So the 2019 was the very first year where you can start accumulating contributions. So that's the year you can catch up with. But the 2020 was the first year you start utilizing it.
Yeah, yes. So then technically in 21, a person could do unused 19, 20 and 21?
Yes.
So then in theory, someone could essentially, one member can put in 75,000.
That's right. If it's not used.
As a tax deductible contribution, which is a significant amount. If you have then two members, that's $150,000 of tax deduction. In simple terms, corporate tax rates call it 30%, super funds 15% of 150,000.
That's exactly right.
That's a big tax saving.
That's a big tax savings, and that's spot on. Yes.
Yeah. So I guess the message there is for our clients to work with us to understand what they've missed out on in previous years, because they could have a big opportunity this year to make a very large super contribution in the next week. Excellent.
Then the second contribution is called double dip contributions. So what previously we looked at is the previous year's contributions. Now we are talking about the next year's contributions, the next financial year's contributions. So for example, if you want to make more contributions than 25,000, what you can do is you can use the next year's contributions, which is 27,500 now, because the contributions cap is increased from 2022 financial year. So in total, you can make more contributions. What is the eligibility of that is that you need to make those contributions hit the bank account before 30th of June this year. Yeah. So once that amount deposited in a bank account, then you can allocate contributions separately different years. Let's have a look at the example. Oscar is a self-employed and makes a total concessional contribution of 25,000 for this year, financial year ending 30th of June 2021. But on 8th of the June, because in the June, you need to make these contributions. You can't make a contributions for the next financial year before June month. So he makes, on 8th of the June, he makes a further concessional contribution of 27,500. So in total, he's making $52,500 worth of contributions. And then Superfund Trustees, what it does is it allocates 25,000 for this year and 27,000 for the next year. The only thing which you need to be careful is you can't claim the contributions in the next financial year because you have double dipped it, which means you have claimed it this financial year.
So the best way to describe this one is it's like a bring forward. So you're bringing forward next year's contribution into this year. So we can then combine the carry forward concept we spoke about before, 19, 20, 21, we can do all that this year, and we can do 22's contributions. So we can, in theory then, could we then do 4 years of contributions?
That's right. So in particular theory, for example, this one, 77,500 is a deductible super contributions with using both the strategies. And then the total net savings would be $11,625,000 just by making a contribution in Superfund.
Yep. Excellent. That's great.
Okay, so the second tip is the downsizer contributions. The downsizer contributions are the contributions where you live in your house for more than 10 years and you sell the house and then whatever the extra money you have, if you want to buy the new house, you can buy it. If you don't want to buy it, there is no necessity to buy the new house. But whatever extra money you have, you can put into the super fund. And the purpose of doing that, if you want to increase the super fund, but now you can't do that because of the various contributions restrictions out there. to be able to make these downside contributions, what are the eligibilities? So the first is you have to be age 65 or older. The second one is you or the spouse, its main place of residence, and you would have lived at least 10 years in there. The contribution has to be made in a superannuation fund bank account within 90 days of the settlement. So not the contract, but the settlement. Once the property settled, within 90 days, you need to put the money in the superfund bank account. And as I mentioned before, there is no requirement for you to buy the new house. So which means if a person sells the house for 600,000 and between husband and wife, they both can put the whole amount into superfund if they are eligible.
So what I find interesting about this one, Nilay, is that it's called a downsizer contribution, but it's slightly misleading in terms of what the government has called it and intended it, because technically, could a taxpayer sell their home and buy a larger home?
That's right.
And still contribute to this?
That's right. I think it's just one of the ways that you can put the money into the superfund. That's what I think they're encouraging people to do. But then there is no restrictions that whether you need to buy the house, you need to buy the similar level of house, the smaller or the bigger house. Yeah.
So this may provide a unique opportunity for people, I think, who are planning around their superannuation balances, and they might have already exhausted some of the caps because there are some limitations on what you can put into super. And this might give them a new balance to take advantage of if they'd like to boost their super balance.
That's exactly right, because the people about 67 years of age, and if they're retired, if they want to make any contributions, they can't because they're not working anymore. They need to meet the work days. For those sort of people, if they want to increase the self-managed superfund account balance, then these are the very good alternative to do that.
Excellent. So a little example you've got there. John and Fatima sell their home.
The Fatima and John sell their home, 600,000. Only John was on the title. So both John and Fatima meet the above-mentioned requirements, and therefore between them, say 300,000 each, they can make 600,000 in superfund as a contribution.
Excellent. Great. Tip number 3.
This one is really important, and it provides a significant amount of tax savings, which is retirement pensions. So the pensions are very important ways of tax saving if you're eligible, because when you commence a pension, all the incomes and the capital gains supported to that pension account would be tax exempt. So what is the eligibility? So you have reached a preservation age and you are retired. Most of the people, because they have there is a age table that if you're born above particular age, then your preservation age is X, Y, and Z. But the most of the people, if you are 60 and retired, then you fall into that category anyway. So the second category is you are 60 and you are retired. And the third category is you are 65 years old. You don't need to be retired for that particular categories. So in these particular categories, if you fall into that, and if you commence a pensions, you save significant amount of income and capital gains from that period because the pension benefits are provided. Yes.
One of the little traps we often see, Nilay, is that a client will come to us. We will provide some advice. That is to commence a pension. Pensions commence, but then they continue to make contributions because they're eligible. They then have this second account to the pension account called an accumulation account that's still there, which creates this situation where pension account not taxable, but accumulation account remains taxable because they're building up a new balance. Would it be fair to say that to get a tax-free status relies on continuing to monitor what's in that fund member balance, not just accepting that when you started a pension, that's it. It needs to be reviewed all the time?
Oh, absolutely. It needs to be required, and regular review and proper attention is to be provided, because you can commence a pension up to a certain limit, and once you reach that certain limit, then you cannot have the pension in that balance. But until you reach that limit, you keep making the contributions and commencing more pensions up till you reach the limit. So it's really important to keep an eye on that. Let's have a look at the example how effective this pensions strategy could be. For a member bought CBA shares in 1992, 10,000 CBA shares for adjusted price of 1.49. So approximately the purchase price was $15,000. Now, after several years, that person commences a pension in 2020 financial year. And after commencing a pension in several months, that person sold all of those shares for $101, for example. The total sell proceeds were $1 million. Now, the capital gains was, because 1 million minus 15,000 was the purchase price, so 985,000. But because the person commenced a pension in 2020 and 100% of the member account balance in pension account, the member didn't pay any tax at all.
It's still an extraordinary tax break, isn't it, when we think about it? A $1 million capital gain, ordinarily in the super fund, there'd probably be about $90,000 of tax on that particular gain. About 10% would go in tax.
That's right.
But because the person started a pension, that $90,000 tax doesn't occur.
That's right. That's right. So the super fund itself is a very good tax vehicle where, in this particular case, if you don't have pension, you end up paying 98,500 tax, which is 10%.
Yeah. So as a client, as a member of a fund, what I think is important to note is that if someone is contemplating selling an asset and they are around that age of 60 and above, you must talk to us. You must come and tell us, because if you don't, there's potentially a significant transaction cost that you may not have considered. And you can commence these pensions in advance of selling the asset if you're eligible.
That's right. And that's the whole point, that you don't have to be in a pension account for all the times you held the asset. It's just that when you sell it at that particular time.
A question from David in the audience, his question is, does retired mean not working for a salary? Can I still get passive income? Presumably, by that would mean share dividends and rental, and be counted as retired.
Absolutely. Yes, you can consider as a retired if you are only receiving passive income. The retirement from the SIS point of view, it's you are engaged with an employment activity or the business activity. So if you are not doing any of them, then passive income is not considered as the passive income would be considered as a retired. Yes.
And it is possible for individuals to retire, and retirement comes in many forms for people. It's selling a business, it's resigning from a job, all that sort of things. It is possible for them to have an extended period or some period of retirement and then become re-employed at some future point.
Definitely. So what happens is when you retire, which means you change a job, for example, you retire from a particular job, and at that particular moment, if you make a retirement declaration that I am retired at this particular age, and then if you choose you change your mind, and in a month's time or 2 months' time, you re-engage your employment contract, or you start another business, that's okay. So it's not that once you make a retirement declaration, you can't re-engage with your employment or the business. You can do that, but it just at that particular time, because you are retired, you can commence the pension and start getting the benefit out of it.
Excellent. Tip 4, capital gains in superannuation.
The capital gains, it's as we expand a little bit into the previous tip, let's look into more detail at how the tax savings would be. So compared to other entities, which is a company, for example, which has a 30% tax bracket, to make it calculation simple, the SMSF can provide significant amount of saving. So for example, if the person doesn't have any pension, let's have a look at that example. Michael has a BHP shares in his super fund held more for 15 years and sold in 2021 for capital gains of 500,000. So how the capital gains works in super fund, I'll explain to you in that example. So first of all, super fund gets 1/3 of the discount of the capital gain. So if you hold more than 12 months period, then you get 1/3 discount on the capital gains, which means the 500,000 capital gains will be reduced by 166,667. So the remaining amount of residual gain becomes $333,333. So the super fund end up paying 15% tax on that $333,333, which is 50,000 tax. So the net tax is 50,000 on 500,000 gain, which is a 10%. So in super fund, you end up paying 10% capital gains if you don't have any pension. But let's have a look of the same situation with the person who is having a pension. So Michael is about 60 and retired, and his super fund is in 100% pension phase. So again, the same situation, Michael has BHP shares and then sold it for 500,000. Now, because he's in 100% pension phase, there is no requirement to calculate the 1/3 discount or whatsoever, but the whole 500,000 is become exempt income because you don't have to pay any tax on that. And that says the whole 500,000 is yours to keep and no tax is payable for whatsoever.
So Nilay, in summary, there's three options. Option one is, and this is going from best option to least attractive. Option one is taxpayer or member in pension sells $500,000 or makes a $500,000 capital gain on BHP, pays zero tax in pension on that gain. That's first option. Second option is also owned in super, this $500,000 gain, but the person's not in pension. They're going to pay that $50,000. Third option is the person bought these shares, let's say, in their personal name, or even in a trust. The maximum tax somebody would pay would be up to $125,000. That's
right.
That's regardless of whether that person's in pension or not. That's up to $125,000 in tax. So you can see, going back to the original little chart that we had at the start of the presentation, someone could enjoy capital gains for a long time on an asset, but if it's not structured correctly for tax, we're talking about $125,000 of a $500,000 gain going to the tax office.
Yeah, it's a significant savings if the super fund used properly, and that's the reason,
interesting, that decision to buy those BHP shares, that's not something you make that many years earlier. That's a decision that's probably made when someone is referencing back to stages of life and someone's in maybe their 40s or their 50s. They're building up their super fund or building up their retirement assets rather, and they might have said, look, I'm not going to seek to get advice. I might just go and buy this in my own name. Rather than maybe planning out and thinking, well, what might happen here? What could happen with my ownerships? Michael's just asking to us, Nilay, this is a member of the audience, to just clarify. What we mean by that, Michael, is that if you own assets in your personal name or in a trust, there isn't the same concessions for capital gains that there is within superannuation. And so the way the tax law works for non-super assets, it doesn't discriminate between a retiree or a not retiree. You're taxed exactly the same in the sense that the rules apply to you. You're taxed on your capital gain. The maximum tax rate for long-term capital gains outside of super is up to about 24.5%. About 24%. That's the max tax rate. So if you have a $500,000 capital gain, 24% of that, $125,000, would go to the tax office. Versus the optimum scenario, which is someone who is retired and has started a pension, they would pay zero on the exact same equivalent capital gain. So that's how that would work. The next question is, or the next part of is buying a property in superannuation. We've mentioned shares, but Nilay, how does a property work in super?
So the property, along with if you have a business or if you have other investment strategy in relation to the property, it works well as well. Let's have a look at the example. So John and Sarah bought a commercial property of 900,000 in super fund by using their personal bank, like a personal member account balance at that time, 400,000, and the remaining amount was borrowed through the remitted recourse borrowing arrangement. Then John used that property to run his business. So the business was paying a rent on a commercial terms to the super fund, and then super fund using that rent to repay the loans and the other property related expenses. This happened over the years until John wanted to sell his business and wanted to retire. Now, he sold the business, and because he sold the business, he was retired from the tax point of view as well. In the super fund, he commenced a pension. Now, because the property was sold after he retired, there is no taxes payable. So not only the original investment was only 400,000 because that was the original fund, but since then, because of the leverage and because of the future growth of the property over the years, no taxes payable on that amount because they could manage to have a pension set up and they're retired. So
you did mention at the outset of the presentation that there are a wealth strategy outside of super is probably about borrowing. A wealth strategy within super is probably about low tax rates, but limited recourse borrowing arrangements are interesting because it's a bit of both.
Yeah, that's right. It's the best of the both worlds.
Yep. So what we're talking about here in a commercial sense for the audience is that there's about 2 banks now left that do provide these loans, and essentially what they are is that it's a bank loan. It's for a lower loan value ratio and a slightly higher interest rate, but the bank may provide your super fund funds to go and buy property with borrowings, of course. That then means that you're getting borrowed funds to buy more of a growth asset, and also enjoying potentially this tax-free benefit if you ever sell it in pension phase at the very end. And once again, contrasting calculations, you end up finding that the tax on the gain is significantly low or negligible or not at all when it's structured through superannuation. Tip 5, franking tax credits.
So when we looked upon the property, which is one of the major investment class, the second one is the shares. And of course, we had a look of the capital gain side of it, of the shares. Now let's have a look of the franking credit side of it. So because the compliant super fund doesn't pay more than 15% tax on its income, and the most of the frank dividends are more than 15%, because it varies if it's a halfly frank or how much frank it is. But because it's more than 15%, the excess amount would be received as a tax refund from the ATO, which means you are not paying any tax, but on top of that, you're getting the refunds from the tax office. And let's have a look of this situation in 2 different scenarios. One with the person with no pension, and one with 100% pension. So in the first scenario, adverts invest into blue chip dividend paying companies through the super fund. Most of the fund's tax, which is offset against the franking credits, but on top of that, whatever the remaining amount of the franking credits will be refunded back. And the main part is that you can reinvest that refunds to buy further shares, and then you get the compounding benefit of it. Now, the same benefit could be significantly better if you have 100% pension. So for example, if Edward was about 65, the super fund balance was more 2.4 mil, Edward received around 99,000 cash in the dividends, right? And approximately 34,000 in the franking credits. And this is the right example, like this is a practical example. I picked up the data from one of the clients. So this is not a fictitious data, this is real data. Now, the Edwards super fund was 100% in pension phase, which means all the dividend income would be tax exempt. So definitely no taxes payable on that. That's fine. But on top of that, that $34,000 worth of franking credits, which was received, now he's getting, after paying the supervisory levy, he's getting almost all his franking credits back as a tax.
But what we're talking about in summary is that a super fund would, if it owns a share, you know, when we all get our share dividend slip from our, let's call Commonwealth Bank again, and it refers to there as the franked amount, and then refers to the franking credit. What Nilay is talking about is that franking credit is real cash. That's a real cash amount you're now going to fully receive on top of, so CBA's paid you $100 in cash, but then the government's going to pay you that franking credit amount in cash as well. So what it means is that if you're looking at income return on your investment, it's now been boosted by this cash amount. So, you know, if a CBA share is paying 4%, now all of a sudden it's paying 5 or 5.5% of a return, which over a $2.4 million portfolio, it's significant. And this is a compounding benefit too. Nilay just mentioned that, you know, this is every year that you get this particular benefit, not just as a once-off.
That's exactly right. Yeah, so you can reinvest this savings, which you wouldn't get if you would have invested this money through other entities, which means you have the benefit of the tax savings, of course, but then over the years, those reinvested amount would get more dividends, and there's more reinvestments. So it's just a compound effect. Yeah.
We have a question from David once again. He's asked, if I'm retired but live overseas, and I therefore am overseas more than 183 days, but I consider Australia to be home still, presumably maintain connections and ties to Australia. Do I lose franking credits in a super fund? Is there any particular rules around super funds not being able to receive those franking credits anymore?
Okay, so in that case, it doesn't make that big difference from that particular point of view, but so you get the tax the franking credits back. That's not the issue there. The only difference is that if you're living overseas and if you're still a member of a super fund, then the super fund itself is not resident. So you need to be looking into that perspective. But to answer your question, you do not lose any franking credits.
Yeah. Excellent. Well, there are top five tips today. Some takeaways that I'd just like to reiterate to the audience as to this presentation and why SMSF is really an important part of what we do. I think an SMSF is not a wealth creation strategy in itself, but it's part of. You can see there with those top 5 tips, if you maximize the benefits of the taxes that are there, you can compound growth over a long period of time, probably a lot quicker than if you had a non-borrowing strategy outside of super. So I think if you're somebody who's risk averse, doesn't take on debt, and you want to build growth for the long term, SMSF is a very important part of that wealth creation strategy. I think the second thing is, at least annually, you should be sitting down to ask the question of your SMSF advisor, whether it's Nilay, Keith, or anyone else in our organization. You should be asking them, am I getting the most out of my superannuation account, my SMSF, based on where the current SMSF rules sit, where the current tax law is? It's important to ask that every year, because SMSF, unfortunately, is one of those areas where the laws do change quite frequently. And so an annual check-in from our perspective is really important. Think of it like a health check with your GP. You should be asking us around the benefits of your SMSF. And thirdly and finally, I think the message is that SMSF is what we consider a low tax entity. There are lots of tax benefit with the lower tax on contributions, the lower tax on gains and income. But there are exceptions and rules, and there's lots of little complex rules which we've today discussed at a high level, but there's a lot of exceptions to that. So please do correspond with us as much as possible. I think that's all for the audience's questions. And we've hit our allocated time as well. So thank you, Nilay. That's been fantastic to get that snapshot in. If any of you in the audience have any further questions today, please feel free to contact Nilay directly. Even if you don't deal with Nilay when it comes to your SMSF, Nilay is more than happy and available to answer those questions and help put you in the right direction. So thank you once again, Nilay, and thank you to the audience for your attendance. We look forward to seeing you again next time.
Definitely. Thank you.